War, inflation, and an AI revolution. It's survival of the savviest. But is your portfolio built to hide or thrive? This is Inside ETFs, and we're talking about investing in the shadow of war. President Trump's strike on Iran is a seismic shock to global markets, hitting investors at a moment when risks were already piling up. AI is rewriting the rules of wealth creation and destruction, while the US job market is wobbling and inflation is refusing to back down. Together, these challenges are exposing cracks that no single policy can patch, and the old buy the dip playbook is no longer a sure bet. So what's the smart move now? Let's ask Sean O'Hara, president of Pacer ETFs. So Sean, JP Morgan says traders may be underprepared for a potential 10% correction in the S&P 500. That's if the Iran conflict escalates. Is this a moment for investors to step back from equities or stay invested?
For now, I think is stay invested. The 10% correction in the market is something that happens quite often, and I don't think it's something that would normally warrant an allocation change. I think everything today is sort of, tied to one thing and one thing only, and that is the price of oil. It was a very crazy day yesterday with oil, rocketing up to $110 plus, and now it's back down to 90. I think if we can get that situation squared away, if you will, and we can get the oil flowing, past the Strait of Hormuz, then, when you look at the overall backdrop, the market seems to be in pretty good shape. Earnings are growing at double digits. PEs are a little elevated, but not insanely high. So I think for now, you just kind of sit with what you got and wait to see what happens with this conflict in Iran.
You have highlighted recently that opportunities do lie in repositioning internationally, but with emerging markets selling off amid the conflict, where are the most compelling opportunities globally right now?
I think what has happened over the last 4 or 5 years is, the U.S. had been deemed to be the only place to be, and so people probably got overweight, in particular large cap, U.S. equities, and even more specifically, 7 names, because they take up so much space. So I think this is a good opportunity to sort of reassess your global allocations and start to sort of lean into some of the international and global strategies as a buffer or a hedge against those highly concentrated U.S. broad market indexes.
Well, let's talk small cap stocks now, and the rally has been driven by expectations for rate cuts and stronger growth. But if higher oil prices delay Fed easing, does that undermine the whole strategy?
Yeah, I think it puts pressure on on everything, to be honest with you. It's going to impact, all stocks across the market, large, mid, and small, as well as potentially, international and global and emerging markets. And so I think that's, my opening remarks were, that's really the linchpin, if you will. Is the Fed going to cut? I think there's hopes that they will, although if inflation doesn't sort of get under wraps, and higher oil prices definitely have a negative impact there. So I'm not expecting, unless we can get the price of oil back down into the 60s and start to see some real progress on inflation, I'm not expecting the Fed to do anything. So
you mentioned, Sean, diversification away from the 7 usual names. And as the earning gap continues to widen, where can investors find attractive growth opportunities beyond the usual tech giants, especially as rising energy prices are tightening margins ahead of the earnings season?
Well, there's been a shift towards quality. The last couple of years in the market have been driven by momentum and low quality. So this shift toward quality, or what some people might call value, is one way to diversify away. In our large cap value fund, we have a pretty hefty weight to energy. So, you can get exposure to that, which has been a nice place to be these last couple of days. And then we're overweight healthcare. So again, not tech necessarily, but healthcare. We do own some tech in that fund, but I think diversifying away into some of these other sectors, as opposed to being so highly concentrated and leaning on, the build out of AI, as you mentioned, and these big mega caps, tech stocks, is a place where you can sort of position portfolios so that you can get diversification, and you'll get, diversification means that there's not correlation, right? So if you just simply are going to stay in the S&P 500 or the NASDAQ 100, for example, you're going to be highly correlated to those 7 names. And so diversifying away from those by using strategies that are not market cap weighted, we don't market cap weight our funds, that puts more money into some of the smaller names throughout the indexes. And so that's one way to sort of manage this risk.
Sean, you mentioned it was a crazy trading day yesterday. Wall Street staging a dramatic comeback after President Trump hinted at an early end to the war. But how can investors build a long-term strategy when the market mood is shifting so quickly?
Well, I mean, the main thing is to just, maintain your exposures. If you own stuff because you think over the long run they're going to do fine, then there's no reason to panic at this point. It was really, I thought yesterday was a terrific day. It showed that the market's really resilient. I mean, I was looking at futures on Sunday night and they were down close to 2%. They opened down more than 1%. And then throughout the day, they rallied back. I don't think when you see that kind of market action that's a negative sign to the downside. I think that shows that this market is fairly resilient and that the underlying fundamentals continue to be strong, at least for now. If we go to 6 months worth of $100 oil, then that changes the narrative. But my expectation is that, this will eventually, in a relatively short period of time, sort of all take care of itself and we'll be back to more normal markets.
That was Sean O'Hara from Pacer ETFs. Don't forget, you can watch more videos on Reuters.com.